How is everybody doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, we are continuing part two of looking at this first report from the Small Business Credit Survey, which is issued by the Federal Reserve. If you call it yesterday, I kind of tried to explain a little bit about the survey itself. We looked at the Federal Reserve website a little bit, showed a little bit about some of the different reports that came out there, and then we started to get into the executive summary. Now, what I want to do is I want to finish up going over the executive survey here. The executive summary here in episode 2. And then we're going to look at some of the charts and graphs in the report to kind of wrap it up. But like I said, instead of doing this as like a 30-minute episode, I figured I would just break it up into a couple of parts. So, but let's continue here with the executive summary. So we're just going to dive right into this. So the share of firms that applied for loans, lines of credit, or merchant cash advances remained stable year over year. Approvals were steady as well, but applicant satisfaction with their lenders fell. So 37% of firms applied for a loan, a line of credit, or merchant cash advance in the prior 12 months, which was basically unchanged from 23 and in line with pre-pandemic levels. Applicant firms were less likely to apply at very large banks at 24 than in 23, 39% versus 44%. Application rates at other sources mostly remained stable. The share of applicants fully approved was steady year over year, but remained below pre-pandemic levels. Applicants that sought financing at small banks were more likely to be fully approved, 54%, than those that sought financing from other lenders. The net satisfaction with lenders among financing applicants declined overall between 23 and 24, falling most among applicants to online lenders from 15% to 2%. Wow, that's a big one. Applicants at online lenders were more likely than applicants at other sources to experience challenges with their lender. High interest rates and unfavorable repayment terms were the most common challenges at online lenders. So, so let's just talk about that for just a second. So, and I'm sure we'll get into some of the charts here in a minute, in a few minutes. So let's look at that. But online lenders. So again, I say this about online lenders. The upfront experience is usually very nice. They usually have a very nice website. You log in, it's user friendly. You could kind of click through everything. You're able to upload your application, whatever financial data or information they're looking for rather quickly. Put in all the necessary information, upload, boom, you're done. And that can usually, I would imagine in most instances that could be done in probably just, 10 or 20 minutes. Maybe not even that long. But then, usually you're hearing back from them within an hour, a couple hours, or maybe even 24 hours at the most as to whether or not your loan application has been approved. So say you get approved in a couple of, 3 or 4 hours, they're back to you. Yeah, your loan's approved. You're all good. We'll deposit the money. And then the money basically comes in within 48 hours. Boom, it's in your bank account. So that's all great. That's all good. But now here's where the problems start. The problem starts that your interest rate might be as high as, 70%. Yes, I didn't misstate that, 70% or higher. And the repayment method. So say you get a loan, say you take out a loan for $50,000. A lot of times you'll have to pay that $50,000 back within a year. And they're not going to take a payment once a month, which is more traditional with just about every bank out there. No. They're going to take payments every week out of your account. They're going to hit your account every week for a loan payment. So that basically that's 4 loan payments a month. So basically spread it out over 52 loan payments every week of the year. And those loan payments are going to be high. They're going to be very high because your amortization schedule is very low over a 12-month period, and you have super high interest rates. And so basically what people find is that these loans are very easy to get into, but they are very painful once you get into them. And they really mess up your cash flow once you get into them because it is a huge burden to be able to meet those obligations. So like I said, so I just wanted to talk about that a little bit. But let's continue on here. So 2024 survey sought insight on some special topics, including the composition of firms' customers, the physical space in which firms operate, and the insurance coverage they maintain. The survey finds that although individuals are a significant source of sales for a majority of firms, about 1 in 3 businesses sells mostly to other businesses or entities. When firms were asked about the types of customers that account for 10% or more of their sales, the most common response was individuals at 67%, followed by other businesses at 54%, state and local governments at 15%, and the federal government at 7%. Most businesses serve a significant portion of their customers at their business headquarters, 21%, or within 50 miles of their headquarters, 59%. 7% of firms said that international customers account for less than 10% of their sales. The majority of firms, 59%, rent the space that is used as their business headquarters, while 17% own the space. Another 17% are headquartered in a residence. The distribution of firms' physical locations is virtually unchanged since this question was last asked in 2019. So in 2024, 25% of businesses said that they had moved 1 or more times in the past 5 years, lower than the 31% that said the same in 2019. Among the types of insurance coverage carried by businesses, liability insurance was the most common at 91%. The most frequently cited insurance-related challenge was cost at 70%, followed by complicated, confusing policies at 29%. So, and then I'm not going to go about the survey. We kind of talked about that. I hit that in yesterday's episode, part 1, if you want a little bit more depth information. But definitely some very interesting information there in terms of from a banking perspective, only 17% of the businesses responding to this owned their space. Another 17% were operating out of their house, basically. 59% of firms were basically renting space. That's a huge opportunity out there for bankers. That's a lot of people that could be buying some buildings out there. So that's great. So that should give you a little bit of idea of as to some people to focus in on if they're renting space. So, okay, let's go. Insurance coverage is an interesting thing. Obviously, the cost of insurance has dramatically gone up in the last 5 years. I mean, I think from 2020 to 2025, I think on average, a lot of insurance policies have gone up between anywhere from 30 to 40% on average over that 5-year period of time, which is a pretty significant increase. So, like, in other words, if you had a policy that was $1,000, you're probably paying at least $1,500 for that today. So, pretty significant increase. So, okay, so now getting into the report here itself, we get, notes and definitions, financial service providers, talks about credit risk, and now we get into the crux of what's, the charts and graphs here. So, performance and challenges. Net share of firms reporting revenue growth declined year over year. All performance indices have recovered from their pre-pandemic lows, but remain below pre-pandemic levels. So profitability at the end of 23, we can see here at profit 46%, at a loss 35%. Revenue change for the prior 12 months, 38% increase. At 41% said they had a decrease. Employment change in the prior 12 months, 51% reported no change, while 23% had a decrease and 26% had an increase. So pretty even there. Employer firm performance indices, prior 12 months. So employment growth versus revenue growth. So we got 4% growth versus negative 3% revenue growth. So we saw this dip in 2020, but then come back up here. Performance and challenges. At the time of the survey, expectations for revenue and employment growth in the next 12 months were little changed from a year earlier and remained below pandemic levels. So 58% said they will see an increase in their expected revenue change, but 24% will not. 18% will decrease. Expected employment change, 38% said they will have an increase. 51% said it will not change, and 11% said they will have a decrease. So basically, a lot of companies saying they're pretty much going to stay steady there. Employer firm expectations, again, revenue growth expectations, 39% here. Employment growth expectations, 26%. Again, we've seen this kind of hold pretty steady here over the last 4 years. Compared to a year earlier, firms were more likely to cite challenges reaching customers and growing sales and less likely to report issues with supply chains. So reaching customers and growing sales, 57%, a little bit higher. Hiring or retaining qualified staff, 51%, a little bit lower than in 23. Supply chain issues, still an issue, but down somewhat significantly over the last year to 29% from 41%. Utilizing technology up a little bit at 29%. Complying with government regulations up a little bit at 29%. Hopefully that one will be coming down. And then let's continue on here. Rising costs of goods, services, and wages remain the most commonly reported financial challenge. Firms were more likely to identify weak sales and paying operating expenses as challenges in 24 than in 23. So rising cost of goods, services, and or wages, still high at 75%. Paying operating expenses, 56%. Uneven cash flow, 51%. Weak sales, 48%. So again, interesting stuff there. Actions taken in response to financial challenges. Used personal funds, 55%. Used cash reserves, 51%. Raised prices and business charges, 48%. So obtained funds that must be repaid, 38%. Cut staff hours and or downsized operations, 36%. Made a late payment or did not pay, 24%. And then obtained funds that do not have to be repaid, 7%. Let's keep going on here. So 19% of employed firms are growing. So growing firms are defined as those with increasing revenues, increase their number of employees, and plan to increase or maintain their number of employees. Again, operational challenges, hiring or retaining qualified staff actually came down a little bit from the last year at 49% compared to 61%. Growing customers, growing sales, 59%, up significantly from 47% the year before. Utilizing technology, again, remaining about the same, about 28%. Complying with government regulations remain exactly the same. Supply chain issues went up a little bit. All right, debt and financing. So the share of firms with debt was mostly steady compared to 2023, and the share with more than 100,000 in debt remains substantially elevated from pre-pandemic levels. So the amount of outstanding debt, 29%, again, no debt. 33% had over about 100,000, and then 39% had over 100,000. So again, this is an interesting aspect to think about because you basically have small businesses operating in a third. A third operate no debt whatsoever. A third have a little bit of debt, and then a third have probably considered a significant amount of debt. And, so as a banker, the ones that you're going to target are obviously the ones with no debt and the ones with a minimal amount of debt. The ones that are basically have a lot of debt could be over leveraged. You're going to be a lot more cautious with lending to those companies. And I think that's what you kind of saw play out in some of the, what we saw with like the declines of loan applications and things like that. So amount of outstanding debt. So 61% hold 100,000 or less. That's interesting there. 39% hold more than 100,000 in debt. So 14%, 100,000 to 250,000, 16%, 250 to $1 million, and then 8% had over $1 million. About 8 in 10 firms use a bank as their primary financial service provider. So large banks stated 45%, small banks 35%, credit union at 9%, financial company that is not a bank 7%, and non-business does not use financial services 3%. Use of financing and credit. So credit card percent, high, 58%. 50% got a loan. 38% use a line of credit. 14% trade credit. 13% lease. Merchant cash advance at 6%. Factoring at 2%. I'll have to do an episode on factoring one of these days. Debt financing, demand for financing. So more than half of firms sought some type of financing in the 12 months prior to the survey. Firms most often applied for financing to meet operational expense. So again, reasons for applying: meet operating expense, 56%, expand business, 46%, have available credit for future use as needed, 40%, and then make repairs or replace capital assets, 27%, refinance or pay down debt, 27%. And then again, 40% of applicants sought less than $50,000 in financing. So kind of interesting. And again, those are small loans for a lot of banks out there. A lot of banks out there are not going to be, I'll have to talk about this in another episode. A lot of banks out there are not going to be crazy about making loans for $50,000 or less because economies of scale. Like you just can't make any money making somebody a $20,000 loan. It's almost impossible to make money. Your underwriting costs are, going to be, anywhere from $1,500 to $2,500 to underwrite that loan. And for 50,000 or less, you can't make any, it's impossible to make any money on that. But like I said, we'll talk about that in another episode. And then finally here, total financing received. Let's see here. 41% got all the financing they were looking for. 14% got most. 22% got some. 24% got none. So reason applicant did not receive the full amount of financing sought. Business was not approved for at least some of the financing sought. 73%. Business did not accept some or all of the approved financing. 28%, and applications were still pending at 14%. Again, a lot of great information in there. I wish I had the time to run through all of this. But again, go in, check. I would highly recommend, go in, check this report out. A lot of great charts, graphs, and information in here. But I hope people just kind of got the gist of this report, got a little bit more information on what small businesses are doing. For the most part, small businesses are doing okay, but there are a couple of red flags there. Beginning to see some revenue growth, a couple of small businesses worried about their revenue growth and whether or not it's going to grow over the next 12 months. We see that, supply chain issues are still an issue. Rising costs of goods is still a big issue. A little bit easier to find employees right now. But again, a lot of firms out there not necessarily looking to do a whole lot of hiring. So, and then we got an idea that basically still very satisfied with a lot of their local community bank, not very satisfied with online lenders right now. But most people are happy with the experience and still able to get most of the financing or most or all of the financing that they were looking for from whoever they applied with. So a lot of great information here, a lot of great information here to look at. And like I said, there's a link to the report down in the description down below if you want to go check it out. But with that, I'm going to wrap up, and I'm basically to say, if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I love getting back to everybody. And as always, make sure to check out some of the other content on the channel. If you missed part 1 to this episode, go back and check that out from yesterday, so you could hopefully see both parts in its together and get the full spectrum of this report, as it were. And then also don't forget tomorrow night, BND Strategy Room live stream live on YouTube at 8 p.m. Please make sure to tune in and check that out. Hope to see everybody there. I hope everybody has a wonderful rest of the week, and I will see everyone again real soon. Thanks a lot for listening.